Good morning, everyone. This is Aditya Khemka. I manage the InCred Healthcare portfolio at InCred Asset Management. Healthcare did not do very well in FY22 and FY23. The reason for that largely was there was severe cost pressures on the healthcare companies. A majority of this cost pressure came from raw material prices going up, which were being imported from China. Secondly, the freight cost and the power cost also went up because of the COVID-related complications that existed in these 2 years. But the most important impact was coming from China due to higher raw material cost. In the first half of FY24, what we have noticed so far is many of these cost pressures are getting resolved. So China has started producing chemicals at full pace. In fact, they're dumping chemicals as we speak today in the markets like India. And that's resulting in a very fast and quick decline in chemical prices. And that's helping the healthcare and pharma companies to produce products at cheaper costs. And that is reflecting in improvement in margins that we have noticed for healthcare and pharma companies. We expect this improvement to continue over the next 1 to 2 years as China continues to produce at full steam. Now coming to the 5 buckets of healthcare, what is our outlook and how do we see valuations in these 5 buckets? Given that the market is slightly frothy, I'm sure many of you are concerned about what kind of valuations are we entering these stocks at and what's the future outlook for these stocks. So let's talk about the 5 buckets one by one. The largest bucket where we are bearish is the unbranded generic bucket. Now the unbranded generic bucket is about 45% of the index which we track, which is the BSE Healthcare Index. However, in the unbranded generic bucket, we have seen a significant rally in stocks like Sun Pharma, Dr. Reddy, Lupin, Cadila, Biocon, Aurobindo, and they have seen a significant rally in the past 2 years. We believe a majority of this rally is unwarranted. The stocks are trading at very, very high valuations when you look at the trading multiples, excluding one-off opportunities. Now, what are these one-off opportunities? Opportunities in generic Revlimid, opportunities in generic Spiriva. These are 2 years, 3 years, 4 years cash flow. But if you look at some of these companies, they are trading anywhere between 20 times to 40 times P multiples, which implies that we are giving these 2-3 years cash flow a multiple of 20 to 40. Now, these cash flows are not going to sustain beyond 2 to 3 years. And then what will happen is you will again see a cyclical downturn in these stocks once these cash flows go away. Now, therefore, this becomes a fastest finger first game as to what price you enter, what price you exit. Do you exit before others exit? Do you panic before others panic? This is not a structural investment. And hence, we at InCred Healthcare Portfolio look at this bucket as a trading bucket. Even before we enter a stock, we have an exit price ready. And we exit these stocks at the predetermined price as and when we buy the stock. Coming to the second bucket where we are extremely bullish, that's the branded generic bucket. Now, if you see with the branded generic buckets, the largest stocks like Torrent Pharma, Mankind, Ipca, JB Chemicals, they've seen a significant rally over the past 3 years, which is essentially a vote of confidence to our thesis that branded generics is a much better business model than unbranded generics. However, these stocks have now become very, very highly priced. But the small and micro cap stocks which are branded generics are yet to be repriced in a similar fashion. Given that a majority of our portfolio allocation is in the small cap space, we expect the trend to continue and even linger down to small and micro cap space in the near future as these stocks continue to deliver secularly growing earnings and higher margins and more importantly, higher return on capital. So we remain extremely committed to the branded generic space and we feel that this space over the next 2 to 3 years will give extraordinary returns to our shareholders. In the API CDMO space, we divide it into halves. One is the generic API companies, the other is the CDMO companies. Generic API companies, because their customers are cyclical, the unbranded generic bucket, these companies are also cyclical. We have played this bucket successfully in the past, again as a trade. We enter at a price, exit at a price. But today we don't find value in this bucket to buy anything as of now. On the CDMO side, we are structurally bullish. We believe the large pharma companies, the big pharma companies of the world have decided that their job is to do research and marketing. So everything in between, which is essentially manufacturing, late-stage research, they are willing to outsource and they'll continue to outsource, which is where the CDMO companies come into play. And these companies will continue to get more and more orders and will continue to hire and will continue to execute more orders. And that will basically help the stock prices and cash flows of these companies in the coming future. So we remain committed and bullish to this space. We were amongst the first guys to talk about hospitals as an investable bucket. However, we spoke about this bucket about 2 to 3 years back. And as we see now, after 2 to 3 years, most of these stocks have become multi-baggers. The valuation of majority of these hospital stocks today are the highest that they have been in their history. That concerns us because we are not about buying any stock at any valuation. Our investment philosophy entails buying good quality businesses at reasonable valuations. Hospitals are a great quality business, but the valuations today are no longer reasonable. Hence, we have cut our weight significantly in hospitals. We have only one hospital stock now in the portfolio, which has some reasonable valuation and a great business model. But other than that, we don't hold many hospitals. However, we understand that the business will continue to do well. But because valuations are not reasonable, we don't see a good enough return being generated in the space for our stockholders. Hence, we are not going to be overly bullish on hospitals at this stage. We remain very, very selective. We are highly, highly bullish on diagnostics at this stage. We believe the investor population made two mistakes. Number one, during COVID, when most of these diagnostics companies were getting revenues from RT-PCR, antigen tests, etc., the investor population treated these diagnostic stocks as if, these cash flows will last for 40 years, 50 years, 60 years. Whereas I'm pretty sure that none of us would have guessed that COVID would last for 40, 50, 60 years. One would have debated whether it would last 3 years, 5 years, 10 years, but nobody was expecting it to last 40, 50 years. So that was a mistake that the investing population made. However, as COVID subsided and these revenues were no longer reported by these diagnostic companies, the diagnostic stocks started crashing. The multiples started coming down, which I think is the second order mistake. Now that these diagnostic stocks are actually reporting what is called base business revenue, sustainable revenue, these revenues deserve a high multiple. This is the business that will sustain over 40, 50, 60 years. And therefore, we find an opportunity to invest in diagnostic stocks today. We believe in the coming few years, diagnostic companies will continue to report excellent top-line growth, which is double-digit or mid-double-digit to low double-digit growth, and a higher bottom-line growth because these are businesses with operating leverage. We find that most of the diagnostic stocks are trading at very, very reasonable valuations today. This is coincided with the fact that many online diagnostic platforms came into play over the last 2 years, and these were discounted platforms, and therefore the investing population was worried if these online discounted platforms can disrupt the business of the brick-and-mortar diagnostic companies. But if you look at the data over the past 4 quarters, a majority of the diagnostic companies, be it Thyrocare, Krishna, and Dr. Lal, they have actually reported acceleration in revenue growth over the last 4 quarters. Now, if there was any threat to their dominance in the space, they would not be reporting acceleration in revenue growth. But that is what we have seen over the last 4 quarters, which is data enough to tell us that diagnostics are not getting disrupted by the new entrants. In fact, they are continuing to growing very, very secularly. And the valuations are also extremely reasonable today versus what they were during the COVID period, for instance. So we believe diagnostic will probably be a star sector in the next 12 to 24 months. And we have taken a lot of concentrated weight in this space, and which will hopefully help our stockholders to make decent returns. At an overall InCred Healthcare portfolio, our weighted average revenue is expected to grow around 12 to 13% over the next 2 years. Our weighted average EBITDA is expected to grow 24 to 25% over the next 2 years, and the weighted average PAT is expected to grow 30 to 35% over the next 2 years. This is driven by the operating leverage and the expansion in margins that I spoke of at the beginning of this video. Hence, we recommend investors to stay invested, top up wherever there is an appetite to invest more in the space, and we hope to achieve very, very good outcomes for our investors. It's always investor first at InCred. Thank you, guys.